Hello and welcome to the Fund Your Retirement podcast, a guest-led podcast aimed at sharing insights and strategies that help you build long-term wealth. Today I'm delighted to introduce Chris Boxall. Chris is the co-founder and director of Fundamental Asset Management with primary responsibility for equity research and management of client portfolios, including the high-performing AIM portfolio services. Prior to Fundamental, Chris oversaw activities at the Washington Financial Group, where he was a director and a key member of the investment management team of the Washington US Fund Ltd, a successful equity fund. While Chris's main responsibility is his role as director of fundamental assets, he's also the co-founder of Investors Champion, an investment research website covering companies, funds, economics, and the hottest topics in global investment. Today, Chris is here to talk about his investing journey, the inheritance tax breaks on AIM, how investing in AIM companies has changed over the last 20 years, the difference between being a private investor and a fund manager, and some of his best investments in the last 20 years, which he still holds to this day. And weave throughout the conversation is a handful of companies that he has high hopes for presently. This was a really insightful conversation from Chris, and one that I hope you really enjoy. Hello, Chris. Thank you very much for joining us today.
Great to be here. Looking forward to it.
Appreciate you coming on the show. And as always, I always like to start off with, how did you get started on your investing journey?
I was thinking about that, and a long time ago, my father was an accountant, and he encouraged me to get involved at a very early age. He said, look, you need to start dripping money into a unit trust, as it was back then, with a fund group that's long since sort of disappeared or been swallowed up by another large group. I think M&G eventually took them over, but he encouraged steady, repetitive investing, drip feeding money in all the time. And after a few years of doing this, and when I look back at my fund, it had accumulated a tidy sum, and it was really a lesson, a fantastic lesson. And he himself was a very good, patient investor. I remember him talking to me about Wolsey Group, which became Ferguson Plumbing and builders sort of merchant products, and how well that had done, a business that nobody was looking at and I'd never heard of. He was a very good sort of guide, I think, and mentor in that respect.
Yeah, sage advice, definitely. It's a great lesson. So what type of investor would you describe yourself? Are you like a
I,
value investor or?
I think we're all looking for value at that right price, and we're all looking for growth as well. The whole intention with investing is to look for growth. So you're looking for growth companies. And as an accountant, I'm an accountant by background, chartered accountant by background. So I'm going to be looking at value. I'm going to be looking at balance sheets, financial statements. I struggle with the great visionary thing. I've got to grab hold of some facts. So I really find it difficult looking 20 years out, the more fairy tale scenarios. And some people are much better than that. They have great vision of where a business may go to. But so I think I'm probably a mix of everything. But I think it's an odd thing that the fund management industries develop with these terminology around growth, value, or balance, whatever. And I think we're all looking for growth at the end of the day.
Yeah, and by being a bit more loose with your labeling, you've got more flexibility to find a hidden gem, perhaps.
Yeah, absolutely. Some people don't worry at all, really, with financial statements. They don't worry at all about the aspects of founder involvement, shareholders, or director remuneration, for example, management remuneration. And I'm pretty focused on shareholder alignment. And we'll go on to our specialism, small cap arena. If you take a close look, remuneration is such a significant part of the profits of lots of smaller companies. And it's something that we pay a close attention. I know others don't. Some managers just like to look at the big picture. They look years out. They try and extrapolate. But yeah, we do like to look at fundamentals, hence the name of our firm.
Yeah, fundamental assets. So
Yeah.
let's go there. So you specialize in small caps. So why is that? Why do you specialize in small caps then?
Prior to fundamental asset management, my business partner, we managed a firm which was based in the US and was really a small cap specialist. We felt there was an opportunity to sort of replicate the deep dive research intensive process in a UK space. When we started off, we had a little bit of seed capital from a friendly shareholder who we'd been looking at after in our previous firm, who said, look, we'll go with you. Then we identified the opportunity in AIM, in particular in the UK. And AIM, this was back in 2004, and AIM was really starting to move. And there were some really interesting little businesses in there. And we cottoned on to the inheritance tax planning appeal of AIM shares as well. And it was a good space to be, to make money, if you were prepared to do your work. There was so much rubbish as well, that if you were prepared to do research and really look closely at things, you could hopefully avoid the rubbish. You're not avoiding everything, all of it, but you're going to avoid the majority of it. And then you could have some supercharged returns out of what's left. And there were some cracking little businesses. So the small cap market was great for us, and where we felt there was a real opportunity for a small niche firm. It's not a big boys game. This is not a game where BlackRock and the
Yeah.
Vanguards or whatever the Fidelities really can add that much value. This is a small firm, private investors opportunity, in our opinion.
That all makes sense. And you mentioned there inheritance tax planning, which is one of your portfolios that you run on fundamental assets. Would you mind just expanding on the benefits of inheritance tax planning on AIM stocks?
Yeah, so companies quoted on AIM or admitted to AIM, a special classification, they effectively benefit from what's called the business relief rules. Previously, it was called business property relief. And this means that the UK tax authorities, HMRC, essentially assess them as they would a private company, which means that if you hold the shares, if an investor holds the shares directly, and directly not via a fund, they can hold it via a nominee arrangement, but it can't be via a collective investment scheme. If a shareholder, a UK shareholder, holds shares in a qualifying AIM company, not all AIM shares qualify, by the way, we can go on to that, but they fall outside of their estate for inheritance tax purposes after 2 years. So if you're an elderly person and are looking to mitigate future inheritance tax on your estate, and conceivably you don't want to give it away, your money away, and you don't want to lose control of it, or you can't. There are restrictions around gifting things as well, because there's the 7-year rule. Essentially, you can keep control of your assets, simply transfer them and invest them into AIM quoted securities. And after 2 years, as I say, they fall out at your estate at death. So you
Right.
have to hold them at death. You don't have to keep the same shares. You can buy and sell them. As long as you sell, you repurchase things of a similar value to the value received when you sold the first one.
That's quite a big benefit, isn't it?
Oh, it's a huge
Yeah.
benefit, and
Huge.
it supports smaller companies in the UK. It's a great way for private investors to save tax, and the Treasury really have supported it. When we started doing this in 2004, you couldn't hold AIM shares in ISAs, and from
Right.
2013, you were allowed to hold AIM shares in ISAs as well, and that brought a wave of new money. In fact, we didn't cotton on initially to the fact that it wasn't just about new ISA investments. It wasn't just about your annual ISA. It facilitated you to transfer existing ISAs into AIM shares and
Mhm.
subsequently reinvest in more AIM shares. So it's been a great advantage, great boost for AIM. No
Yeah.
stamp duty either on AIM shares. I know it's only 0.5%, but
It
no
all
stamp
counts,
duty as
doesn't it?
well. Yeah, it does. It all encourages small company investing, which is really good for individual investors. I know it's ironic, it's viewed as riskier, but it's a great place for small investors to add value to really outperform the big boys.
What's your thoughts on the future threats to this inheritance tax break?
I think there are always threats. There have been threats every year we've been managing it, and even
Yeah.
before then. The tax break was originally established to really facilitate the inheritance and transfer of wealth amongst private companies. I don't think it was originally intended to support multi-billion-pound companies, which effectively it applies to. Some of the businesses on AIM are pretty big. It's always in the back of our mind. However, anytime it comes up and anytime things looking so good, you then have a big stock market sell-off, the economy looks rubbish, and you think, I think the government probably has bigger things on its mind than to tinker with AIM, which business relief on AIM shares is a relatively small part of
Mhm.
the tax take. So why tinker with it? In our opinion, why change it? It
Yeah.
does a pretty good job. Quite frankly, I think they should enhance the tax incentive to smaller quoted companies. It's really needed, especially at the moment. You need to really help and encourage people to buy into growth companies. And there are a lot of those on AIM.
Yeah, we'll touch on that very shortly. It's almost 19 years, coming up 20 years you've been involved in the end market. How have you seen that evolved over that period? It must have changed a lot.
Oh, it's changed massively. I made a couple of notes on where it has gone from. When we started investing in AIM in 2004 for
Yeah.
IHT planning, there were 1,021 companies on AIM, and AIM was the total value of AIM was broadly 32 billion. Then had a boom. We saw this boom of companies coming onto AIM,
Yeah.
and there was lots of rubbish and lots of high growth stuff. There was a whole sort of melee of things going on. and AIM peaked at around about 1,700 companies in 2007.
Right.
So from the 1,000 we started, you had that 700 in only a matter of 3 years, 97 billion market cap, so broadly 57 million. I mean, admittedly, there was a lot of rubbish going on. Fast forward, we're now down to 810 companies, market cap still just under 100 billion, about 95 and a bit billion. The average company now is worth 118 million. So really, you've seen a lot of the rubbish go, a lot of the international stocks go, a lot of the questionable companies go, and now you have a junior market that's full of more substantial businesses. However, if anything, probably shouldn't say this, but it's probably too safe. AIM, rightly or wrongly, one US stock market commissioner referred to it as the Wild West of investing. And yes, it did have elements of that. You had a lot of resource stocks, a lot of speculators, a lot of oil and gas businesses, and there was an awful lot of rubbish. There was some weird businesses from China and that suddenly disappeared or disappeared very quickly. But you had some absolute gems in there, and we'll go on to a couple of that we identified from those times. But you had
Yeah.
some real gems, and it's harder now to find those type of businesses. Typically, companies that list now on AIM are a lot bigger. The other doubt is that they're not interesting to private equity or VC backers. So is AIM the sort of third option for them? Whereas
Yeah.
previously, AIM was the only option. If you wanted to raise smaller money, there wasn't as much VC money around. Private equity wasn't interested in AIM or companies of that size. There have been scant few new issues over recent months. I mean, AIM is in desperate need of some good new issues, some good new entrants to the market, and we
Yeah.
just haven't seen them now for a while.
I'm thinking here, can you describe a couple of companies, perhaps in the earlier days, that have significantly outperformed and what drew you to them originally? And is there anything like that at the moment?
I'll go on to where I think the next one will come from after this one.
Yeah,
The
sorry,
first
there's
thing,
two questions in there.
yeah,
So
the first one is two companies that we came across very early doors on AIM, which performed very well. I think are illustrative of the potential there was and how things have changed. And I'll give you a couple of examples. And we hold both of these companies in our portfolios, and
still to this day.
still to this day. So
Yeah.
AB Dynamics is a specialist engineering group that develops testing systems for cars for the automotive sector. It listed in 2013 at about 86p, and its market capitalization was only 14 million pounds. One
Right.
four. Nobody was interested really. We don't invest at IPO generally. We did a bit more back in those days, but nowadays we're very skeptical. And we didn't actually invest in this at IPO. But this was a profitable founder-led business. The founder was still involved, quite an elderly gentleman. He was still very much involved with the business. Apparently, he tried to get his management to buy into it, but they weren't interested. So he listed
Yeah.
on AIM, 14 million, 86p. At its peak, the shares reached £27, now just shy of 28 quid.
Wow. Nice.
38 to 32 times. They're currently sitting at just over £17. So you can see the market cap now is just shy of 400 million from 14.
Brilliant. Yeah.
Absolutely fantastic. Founder involvement. Key aspect, the business was profitable, cash generative from the word go. It's raised
Yeah.
more money over time. It's made some acquisitions, but organic growth was great, but profitable and cash generative. Another one, little one, much smaller, called Traxis, provider of technology, software, and other services to the rail and wider sort of transport sector. Traxis was I think, a spin out from one of the universities originally, admitted to AIM. So at 40p, market cap was only 7 million. So
Mm.
even smaller. Now it's currently valued at 260 odd million. At its peak, it did about 26 times its admission price. Again, it was tiny when it listed, but it was still profitable, cash generative. The founder, the developer was involved as well. They've subsequently made a lot of acquisitions, look in interesting shape now as well. Both businesses, I think, are key, going back to that, some sort of founder side involvement, and their business models were proven. You weren't just raising more money to throw into an unproven business. They developed things already and they've established that it works, and this business can develop from that base, that stable base. I think that's the fundamental difference to a lot of companies that have joined, where their business models are unproven. They needed a lot of capital just to find out whether they might work or not. The question is, where will the likes of AB Dynamics and the Traxises come from? We do struggle a bit to see that we're now where they are going to come from AIM. And we'll come on to one that I think in the future might be quite interesting. But you're not seeing businesses of that size now joining. They're much bigger, circa 100 million typically is the sweet spot, maybe a
Right.
touch under. So they're not quite as small as that. and often they're only marginally profitable as well. They haven't and suddenly they then go on a wild acquisition and sort of acquisition mania can take over. And I just think that's the wrong way. We like small ones like this that develop first of all organically, then start doing some bolt-on deals. But they've got
Yeah.
lots of proven themselves before.
Do you think that the low interest rates, cheap money has distorted the markets because they're already raising capital prior to launching on the stock market because of low interest rates, cheap money, VC? Do you think that's having an impact?
Yeah, yeah, I do. I think it's made a big impact on AIM. I think AIM is the sort of dirty cousin for where you want to raise money. I think
Yeah.
there are other solutions. Cheap money has just consumed a lot of business areas, a lot of sectors, and that may change given where interest rates are. But private equity still has a lot of money, and you're seeing some very good AIM companies being acquired as well. So often it seems to be engineered by founder management, which we find particularly frustrating as well. So the founder management are saying, I think we can get a better reception off AIM. We can grow, we can make ourselves more money off AIM, stuff the AIM shareholders. Let's go and take some private equity money and probably look to relist in a few years' time.
Yeah. Keep more of it themselves instead of
Yeah,
paying.
that's the impression I get. You do find that it's a funny old market. You have some very good CEOs and founders and management teams, but then you have a lot of promoters and people where the agenda is very different, and not the greatest alignment going on. I do feel that the era of cheap money has changed AIM a
Yeah.
lot.
We will get onto the risks in a moment. You mentioned you do have something on your radar that maybe has the potential to be an AB Dynamics or a Traxys. So just wondering if you'd share a little bit about that.
A couple of companies here that I think they're polar opposites in terms of their profile and what they do. Not sure one of them will be a 10 bagger, but I think it might deliver. It's in an interesting position. One of them who's announced today, the first is Phonix Mobile, Fonix Mobile, and it's involved in the processing of payments through mobile phone and also mobile phone messaging. So one of its services, it supports the likes of children in need, albeit via a sort of fixed contract basis, not on a transactional basis, but it also supports payments around shows like Love Island, a lot of ITV shows. I'm a celebrity as well, taking payments, and it can accept payments on mobile. And Phonics has still got a founder involved, got a big stake. It listed a few years ago at 90p. It's now just over £2, just
Mm.
over 200 million market capitalization. It's got good technology in place, fantastic return on equity, return on capital, great cash flow because it collects the cash itself before passing it on to its clients. And it has the potential to grow overseas as well. Its first forays into Ireland, the potential to maybe move into the US as well. And again, it's proven, its model is proven. It doesn't need capital. My big question when it joined AIM was, why on earth are you joining? You
Yeah.
don't need any money. There was a big insider sell down. I don't necessarily like that. There's a big sell down by existing holders, about 45 million quid. That's a bit of a red flag for us. But it's delivered in spades since. And shares have they've more than doubled since IPO in quick time. It listed that's only in 2 and a bit years. And I think that could have gone to some much greater things.
Excellent. I've heard you mention there a couple of times in these companies, founder-led, proven business models. So proven business models, already cash rich, already cash generative, are important. And I've heard you mention again, say founder-led. That ranks high on your criteria then, I take it, does it?
I love it when businesses, going back to my start, when I was an accountant, I loved visiting companies where, like, understanding about the models, and I loved it when there was a passionate founder involved, somebody that was really knew the company inside out and had been with it since it was in his or her bedroom. That's absolutely fantastic. That's manna from heaven, or in some porter cabin, or whatever it
Yeah,
was.
they've literally
When
built
they
it from the ground up.
they wash the cups up, fill the kettle, and now they're talking about strategy. So they've gone the whole hog. Those businesses are brilliant. The slight difficulty is you are having management founders now that see the sort of financial engineering possibilities on the stock market. Sometimes they do go too far and get a bit over bullish. But yeah, it's a key aspect for us.
Yeah.
You know, one of the other companies that I was going to mention has been around for H&T Group, 125 years. Its
Yeah.
founders have long gone. It's a pawnbroker,
Oh,
financial
right.
services business. It may have come again. given that there are a few other lending options or borrowing options for individuals in these cash-strapped times in which we live, the pawnbrokers suddenly having their day again. Proven business models, pawnbroking is, one could say, a highly ethical means of short-term lending. That's an old elderly business now whose founders have long gone. There's no family involved in that. Professional managers were running it. You have to look at each company in its merits.
You've obviously had a lot of meetings with CEOs and management and webinars and things like that. Have you got anything you can share with the audience that's perhaps maybe put you off, something that you haven't quite liked, body language, the way they've delivered the meeting?
I've never heard a bad story from a CEO, and I can name one great story I heard from a CEO, and a day later his business went bust. So I've never heard a bad tale from a CEO, and I've become somewhat cynical over the years that one doesn't actually hear very much from CEOs, that you only hear what they want to tell you anyway. Nowadays, they're somewhat restricted, they're shackled somewhat. So what can they tell you? We prefer reading the facts and looking at outside industry sources if necessary. So we're far less reliant or dependent on CEO interviews. I'm not, as I say, sure how much value they really add. I would say they're helpful to understand how the business works, to get a good understanding of the model, but really you should be able to discover that if their website and via their AIM admission document. The AIM
Yeah.
admission document, by the way, anybody is looking at AIM shares, you need to look at the AIM admission document. That is full of useful information. And the one section that most people won't look at is risk section. But that has got the most valuable information because it'll tell you exactly where the business is going to go wrong. And it's all there.
Yeah.
It's cost a blooming fortune to write. So you might as well have a look and read of it. We hold far less store by CEO meetings. And quite frankly, the more bullish the CEO, the more it puts us off. I've had some CEO meetings where they won't mention any names, but the person involved isn't the best communicator and comes across as pretty obnoxious and doesn't want to be there, and they've ended up as absolutely fabulous companies. They're
Yeah.
clearly better at running their business properly than the super bullish. And this is a generalization, but many CEOs, chairmen of listed companies are actually not on the coalface. They are promoters. Their
Mm.
job is to sell the story to the city and sell. They're very good at raising money. I am generalizing because others are pretty good. A lot of the founders know their business very well, but some of them are very good at spinning a tale and attracting funds from the city
Okay.
or from the investor base. And that is their primary role. Not necessarily, their forte is not necessarily operational. They sometimes don't know what is going on in their business. And we've been caught with one of AIM's worst scandals. Patisserie Valerie, a few years ago, we were unfortunate enough to have a small stake in it, and it was an out-and-out fraud. We still don't know exactly what's going on, but it was clear that a so-called founder in that business, he was more of a financier, didn't know what was really going on in the business. His job
Right.
was front man, and I think that is the risk. So when people are listening to CEOs or chairmen, you've got to understand who they are and what their role is. Do they really understand the minutiae of the company that they're talking about? Have they ever been the chief accountant or the chief bottle washer or whatever it is, or actually
Mhm.
screwing the tops on things or whatever at the grassroots? And I think that they're very far removed.
That's a really good insight. And I guess that ties in with the founder led has literally probably done every job in that company and they really do understand it. So yeah, it's a really good insight that. Since now we've gone on to risks of AIM, let's dive a little bit deeper into that. We've just had a software company, 818 million market cap, potentially worth zero maybe. How can private investors avoid these types of risks? And the one that you described as well that you were caught in.
The patisserie Valerie one was totally unexpected because you couldn't think of a cake and coffee shop. Much could go wrong with that.
No, you're
It's
right.
not.
Yeah.
It's not exactly a super high growth tech business. This is a cake and coffee shop.
Yeah.
The only job is to count cash and make cakes. But fast forwarding to this one, yeah, it will be a huge. If this business is worth zero, for shareholders to be wiped out to the tune of 800 million without warning, without some warning, it would be
Perhaps not a bit
absolutely
extreme,
huge.
but
I think from a generalist point of view, AIM is the UK growth market for smaller companies. So to adopt some common sense here, in my view. It has got some great little fast-growing niche businesses addressing niche sectors. It is not going to be a market, in my opinion, that attracts broad-scale global market champion that's going to be 10 billion in value, whatever it is, billions in value. Those sort of businesses, the West Coast of America have got those in spades. They know about that market, and various other markets know about it, or the Chinese market. Those businesses are established differently. They have backing, they have known backers. So to think that a small UK listed business has been trading for years is suddenly going to become a global cloud champion, I just think is totally unrealistic. And that applies to this current one that we're talking about. Don't think that suddenly AIM is going to be producing a global multi-billion pound champion out of the blue when the US market doesn't know about it, US private equity doesn't know about it, and US VCs don't know about it. I'm sure they'll be the first to know. And
Yeah.
if it had this kind of potential, they'd have
They're
had
already
something to
invested
say.
in it.
Exactly. They'd have had something to say about it. This company also, apparently, I've never met him, but there were a lot of bullish statements going out from the CEO. It was even a hint of listing in the US. That should have been a positive. But one of the announcements, I think, before Christmas was slightly concerning, where they announced a new contract win just before Christmas, 22nd, I think, which was it was a big contract, $15 million or something like that. And it was due to be completed, or 80% of it was due to be completed by the year end. If they hadn't have
That year end
nailed
that they
it,
announced it.
yeah, just this current year end, the 22nd of December 2022 year end.
Right.
If they hadn't have secured that contract, if you look back at their forecast before then, they wouldn't have hit numbers at all. That seemed to have been super convenient, seemingly. From our perspective, the thing we worry about with a business like that, the accumulation of lots of large contracts very quickly. A small company that's meandering along suddenly has this hockey stick of lots and lots of contract awards. Are they really deliverable? Can they execute? And it applies to a lot of small business. When you have a super growth, some people have the operational capacity to support rapid growth like that, particularly software. You bang it out pretty quickly, although you do need the support in place to do it. But to execute very large specific contracts like that is fraught with risk. So I think if people are looking out for frauds, I'm not saying that's a fraud, but looking out for concerns, that will be one. But going back, but the key point is if you're looking for a multi-billion pound companies going from virtually nothing to that, is AIM really the market? It would be nice if it was,
Yeah.
but I'm very doubtful. I think you're going to find those on the NASDAQ from the US, but it's going to be a struggle. You're going to be a struggle to find those on AIM because the good ideas are generally snapped up before they ever see the light of day on AIM.
I suppose it ties in with yours kind of earlier take on founder-led businesses, proven business models, and reading the AIM admission documents.
On the AIM admission document, it's always under the AIM Rule 26 in the investor relations section. And unlike for listed companies, I mean, it actually provides quite a lot of information. It's really worth people going to that section. Every company is obliged to present, as long as the company been admitted relatively recently. But even if you go back years, you can go back 15 years, the admission document, which sets out the business model and the profile, can still be relevant 15 years later. So it's often worth revisiting.
Would there come a time where you would start looking outside of the UK in light of what we've discussed today?
First of all, our primary client base, if they're IHT planning investors, is tax breaks.
Yeah. Understood.
However, other overseas markets, in certain European exchanges, certain secondary European exchanges carry the same benefits of AIM.
Interesting.
AIM, so they carry the same tax benefits of AIM. So one could look at. It's whether the UK investor base would be happy. Some overseas companies that are listed on AIM also carry the same benefits.
Right,
So just because it's domiciled overseas doesn't mean it won't carry the same tax benefits. For example, there are a couple of US stocks in our income portfolio, our AIM income portfolio. They're actually domiciled in the States. These businesses.
You can still get exposure to international stocks even on the AIM market then.
There used to be more. When it was at its peak of 1,700, there are a lot more, and there was a lot of rubbish, a lot of questionable ones. Now there are far fewer, but those that are left, several of them are quite nice little businesses. One in particular is a nice little company. High margins, ticks a lot of boxes. You may look at it and think, why on earth is it on AIM? But it happened to arrive there many years ago. Going back to our early discussion, when there were a few other options open to it, and it stayed and gone on to thrive.
Is it Somero by any chance?
Yeah, it is. Yeah.
Maynard and Mark did an excellent breakdown of Somero on the Private Investors podcast. So
yeah, no, I remember seeing the management. The guy, the CEO's been there for ages. I think Jack Cooney's been in that business. I remember when they IPO'd on AIM, I met them. Couldn't for the life of me think how this business is going to end up on AIM. There was nowhere else to go. The NASDAQ was too big. Nobody was interested in a concrete leveling business on the
Yeah.
NASDAQ. They ended up on AIM.
All that's been absolutely fascinating. And I'm aware of time, and I'm pretty sure the amount of information that you could share would be, we could fill a podcast for hours. But I wanted to transition on to a little bit about actual managing money. I suspect there's probably certain members of the audience that may harbour ambitions of maybe moving into money management, perhaps. Can you share any sort of insights into the difference between being a money manager versus a private investor?
I think a private investor who's prepared to research, so it's just, we're probably on this topic of small caps, really even larger caps. A private investor who's prepared to do their own work can do very well, but they need to do their own research, and they shouldn't fall overly in love with a single stock. They should manage things by a well-balanced, diversified book. There's a problem with many private investors, in my opinion. I'm a private investor as well as managing money for others, can sometimes be overexposed to a single stock, and that's all you think about. Adopt an element of common sense. Don't be overly exposed to a single stock. In AIM, prepared to take profit as you go. Just that's counterintuitive to running one's winners, but in our experience, and this is where a private investor has a real advantage over institution. They
Okay.
have greater flexibility in being able to get out or even trim off. The real difference between when you're managing institutional money in a small cap market is liquidity. Even
Mm.
if you want to sell on occasions, it can be very difficult because you need to sell for all of your clients. And therefore, to do that, first of all, to do that during markets which are under stress is almost impossible in small caps because liquidity dries out. You just can't sell for love or money, or not for anywhere near the price you want. Even in normal market conditions, once you've built up a several £1 million position, no way you can get out unless you're lucky enough to get another institution to take your stake, which is hard. Private investors don't have that restriction, or subject to size, but they can get to quite a large book,
Mm.
suitably diversified, but they can get quite a large position and have far greater flexibility in being able to sell and buy as well.
Yeah.
It's been another feature of AIM this year. The liquidity has been dreadful. Average daily trading volumes are well down on a couple of years ago, which creates a problem. Those in private investors that are wanting, have an eye on the inheritance tax breaks, should be mindful though of whether their companies continue to qualify. For some AIM companies that may become questionable, they may be doing investments, they may have another listing, another exchange, they may be acquired and be under contract to be sold. So they need to be careful about the qualifying status if they have that inheritance tax planning view on. But other than that, they've got a lot more flexibility, and they should keep a track record as well, an audit trail. If they sell for IHT planning purposes, if they sell a company and reinvest in another, they should be able to demonstrate that trail
Yeah.
of full reinvestment. I think private investors in small quoted companies, while a lot of them seem reluctant to go there, is actually the place where they could massively outperform the big boys. They have that so much more flexibility.
Yeah, that's very similar to what Bruce said in the last episode. He was saying a similar thing that private investors can actually outperform the fund managers in the small cap space.
Yeah, they
Yeah,
can.
really
No,
interesting.
very true.
Let's hypothetically say someone was wanting to make the jump, go into fund management. As you mentioned, when you got started, you were seeded by an already known contact. Is that kind of the traditional route?
It's hard to raise money.
Yeah,
Raising money is difficult. And either you come out from a big group and you've got a great reputation and loads of contacts in the city. We started, we didn't. We had a small amount of seed capital from a supportive client, but it was somewhat unusual. We went Cityites. We'd been running a business in New York as well, and we decided to go into the UK small cap space. So raising money is really hard. Not only have you got to deliver great performance, you've got to deliver it consistently, but you've got to have distribution. So anybody who's thinking about this game, they've got to have distribution. They've got to have a potentially captive audience of backers.
yeah,
That's hard. There's been a lot of consolidation. So a lot of investors come to us either directly or they come via financial advisors. We like clients coming through financial advisors because advisors have given them sort of tax planning and given them the reasons to invest with us. But the financial advisor community has consolidated a lot. And so the groups that are left typically only want to buy from other big groups as well. So it's not easy. I would caution as well, if those interested in the small cap arena, never run small cap money in an open-ended fund. The last thing we manage across portfolios, across
Okay.
multiple clients. We don't run an open-ended fund. Running an open-ended fund, investing in small and micro cap stocks it's a recipe for disaster, because what happens is all your clients redeem when times are tough. So you're having to manage redemptions and potentially selling out of holdings just when you should be looking to buy into them. It's a very bad place to be. So a closed-ended vehicle route is always better. An investment trust or an investment company listed on AIM is a better way of going about things.
Yeah, brilliant. Thank you. You've also shared pretty much a wealth of information on Investors Champion, which is an investment research website primarily to support the private investor network. Would you mind sharing how did that come about
Yeah,
and how that benefits?
it's nearly as old as fundamentalists. I think we kicked it off in 2006. Became a notepad. It was just a blog to begin with. Became a bit of a notepad for our thinking, and so we wrote some pretty forthright articles, and we were somewhat punchier than we are at the
Yeah, you've
moment.
toned it
Yeah.
down a bit.
Yeah, we have toned it. We have toned it down a lot. We're perhaps not quite as direct as we used to be. But
It
yeah, so
happens with that as you get older, doesn't it?
yeah,
You
yeah,
kind
yeah,
of-
yeah. Very realistic, I think.
yeah.
More prudent. Yeah, it unearthed some really bad stocks. We were quite proud of that. Prefer to find good stocks, but occasionally we unearth some real problem cases and hopefully help people along the way. And a lot of our readers said, "Thanks very much. I'm glad I
Yeah,
didn't
for
invest
warning
in
us
that
about
one."
that one.
Yeah. And that's still the tone. As you say, it's a toned down tone. But it evolved from that. So now we've got external writers who support us, and
Yeah.
Roland's been on your show as one of them. Roland Head, he writes very well.
Yeah.
He addresses the sort of more the larger cap arena with a dividend focus.
Hmm.
And we have other writers writing about technology and growth stocks, international growth stocks. We've got different portfolios, and we enjoy it. It's a way of more freely communicating thoughts. And we offer the service, by the way, to all our clients, and free of charge.
Yeah.
Our clients get access to the premium content on it. And it's a way of telling them more about the companies we're invested in, and companies that we're looking at, and
Yeah.
companies that perhaps we want to avoid. It's a bit of fun, and I like
Brilliant.
doing it.
If you want to learn more about your thoughts, companies you're looking at, Investors Champion is the place to go. And
It is. It's good, and it's also got a unique search tool as well. Those it like the inheritance tax benefits of AIM. It's got a separate site called AIM Search, which
Hmm.
tells you which AIM companies qualify and which
Oh,
may not
that's good.
qualify. Yeah, because there's no definitive source for that. HMRC doesn't produce anything, and this is a way of helping people. It's not definitive. It's only what our view is of it, but
Yeah.
can give a guide and where there are problems or where we think there are doubts.
And I will make sure those links are also in all the show notes below that Chris has just mentioned there. But if someone actually wanted to get in touch with you, Chris, what's the best route? Is it through your website? Should they speak to a financial advisor? What's the best route for anybody that's listening to this wants to speak to you about some of your portfolios?
Those people that have got bigger estate planning thoughts should go, in our view, to their financial advisor, assuming they've got one. Those who are familiar with equity investments, who haven't got a financial advisor, they can approach us directly. Go to our website. They can always email me at cboxall@fundamentalasset.com. Feel free to email, especially if they've listened to this show and they're worried about any points that I may have made.
Yeah.
Or not, feel free to contact. Or as you suggested, if they want to get a flavour of what investing in AIM is like and the type of companies out there, go on Investors Champion, or there are other sources as well.
Yeah.
Stockopedia is a great place. Your own show is a great place to listen to people. There's a lot of information out there if you're prepared to look and take it.
Brilliant. Chris, have you got anything you'd like to add or share to this brilliant, really insightful conversation? I've really enjoyed what you've had to say.
I think we've covered quite a lot, haven't we?
Yeah, we
Just
have
looking at
actually.
Just looking at my notes to see if I've got anything that might be probably a 10 bagger. I mentioned one stock where I see the greatest opportunity for AIM now isn't necessarily in the technology space. It's probably it's associated, probably in life sciences.
Life
I think the
sciences, yeah.
UK is pretty good in life sciences, and I think there are some interesting ones on AIM, albeit very small. I think that's where it has an opportunity. We've just come out of a pandemic. I think we proved ourselves over that, and I think could be some good opportunity. And I'd like to think that those sort of businesses can make their way onto AIM. Investors will need to be patient. A lot of these businesses won't be as proven. There will need to be a degree of patience.
And Maynard and Roland actually just did a breakdown of Bioventics on the Private Investors podcast. So
Oh, it's a lovely little business. Lovely little business.
Yeah, I'm going to just get that little plug in there if anyone wants to go and learn a bit about Bioventix.
Yeah, I recommend that to them as well. It's a fabulous, it's totally unique business. They'll be
Yeah.
staggered at the returns that business makes. Absolutely
Yeah.
brilliant. I'd love that business to go on to greater things. It's been doing everything organically. Is there something else it can
Yeah.
do to really, really accelerate? Absolutely fabulous business.
Still founder-led as well, isn't it? So
Absolutely. Simple as it gets. My daughter visited their premises they're in Surrey
nice.
somewhere, they're based.
Yeah.
Because she has written for us and done work for us. And it's so simple. Exactly the type of business you want, a small company you want to see.
Brilliant. Do you have a Twitter handle? Are you active on Twitter?
We've got a Twitter handle. We put out stuff. I think it's at Invest Champion on Invest. Or at Fundamental Fund Asset, I think.
Yeah.
Fundamental Asset.
It's mainly going to Investors Champion where to get your information and knowledge from.
Yeah, but we have both as well. LinkedIn as well. We're active on Fundamental Asset Management. So we've got quite a decent presence on LinkedIn.
I will make sure the links for both your businesses are in the show notes and your social media contacts, including your email as well for anyone who wants to get in touch. Thank you very much, Chris. Really
Thanks very much. Great. That's been really interesting.
Yeah, I really enjoyed it. Thank you.
Okay, bye.
Well, that's it from the Fund Your Retirement podcast. I hope you enjoyed this episode and the many other interviews from our expert guests. Please subscribe and don't forget to check out our other podcast shows. The Private Investors podcast, hosted by Maynard Payton and Roland Head, and the Value Trapped podcast, hosted by Mark Simpson and Bruce Packard. Thank you very much, and we'll see you in the next episode.